This is Matt Godleski with CapTrust Advisors, bringing you this week's snapshot edition of The Pulse. Here's what we're watching this week. Stocks are back near record highs, while the bond market may signal inflation concerns are overblown, and geopolitical risks could provide a jolt of volatility. The stock market was noticeably higher from last week, moving back to record price levels. Treasury yields declined, prompting a strong rebound in growth-oriented stocks. On the economic front, home prices rose the most since 2005 on supply shortages and low interest rates. Unemployment figures fell to the lowest point since the pandemic began, boosting optimism. Businesses are reporting robust hiring to meet surging demand. Core capital goods orders surged while business investment spending climbed by over 13% in the first quarter. Meanwhile, policymakers in Washington debated a fresh round of stimulus to promote growth. One risk that has been noticeably absent in recent quarters has been geopolitical turmoil. Fading attention to the U.S.-China trade relationship has been one major shift from the past 2 years. It may be that markets have grown complacent to this ever-present risk and could be set up for a major risk-off event. Since the change in administrations in Washington, investors appear to believe that geopolitical risk has abated. We see three primary sources for geopolitical risk ahead: a potential resurgence of COVID, emerging market political crises, and the U.S.-China decoupling. Any one of these risks could quickly lead to a rapid market repricing, with risk assets priced to perfection. While COVID and emerging market risk are more tolerable in the near term, the relationship of China with the rest of the world is extraordinarily important. Significant disruptions from China are possible to global supply chains and trade agreements. The current administration is continuing with their predecessors' aggressive rivalry across the Pacific. This stance could increase the pace of reshoring and deglobalization, increasing already rising inflation risks. Adding to tensions, Taiwan and maritime territorial claims remain hot-button issues between the two powers. There remains a long-term threat that the situation there could ultimately escalate to military conflict. Another risk often overlooked is the potential for a major cyber attack, worse than the recent U.S. pipeline shutdown. The ability for countries and criminals to inflict significant damage using this method is often overlooked. We remain pro-risk, but note that geopolitical risk flare-ups such as these could have an outsized impact when markets least expect it. We made adjustments to portfolios this week to reduce some risk exposure. Technology stocks had a nice rebound driven by a drop in yields, and we took this opportunity to trim selectively. We're leaning more into inflation-resistant stocks and reducing growth exposure. We currently see financial stocks, European markets, and energy as compelling investments. We want to avoid any sharp market moves from spiking inflation, so maintaining cash in portfolios in anticipation of volatility ahead is our current strategy. As always, we remain focused on changing market dynamics and make changes only when appropriate. Thanks for watching, and check out our website to read the full version of The Pulse for more details.